Hey everybody, Jason Fieber here, founder of Dividend Mantra, founder and publisher of Mr. Free at 33, and of course I write the Undervalued Dividend Growth Stock of the Week articles for Daily Trade Alert. Welcome to another video today. This is a video series that we started a number of months ago, and each video, the video series in general is designed to complement and add value to the Undervalued Dividend Growth Stock of the Week series, which is a series of articles that we've been doing at Daily Trade Alert for quite a few years now, and every Sunday we highlight what appears to be an undervalued high-quality dividend growth stock for that particular week. So every Sunday we publish that article, we put out a very compelling idea for you readers. It's free of charge, free content, and what we do is we highlight from a high level as well as dig into the fundamentals of a high-quality dividend growth stock. We dig through that stock, and then at the very end we come up with a valuation, and based on that valuation and based on where the price is relative to that valuation, that stock appears to be a pretty appealing long-term investment idea. And we started the video series, which of course we're doing a video today. We started this video series last year. We've been doing these videos twice a month lately. So we produce 2 videos a month. And what each video does is it picks one of the recent Undervalued Dividend Growth Stock of the Week articles. And in this video, we break down that stock and that article and kind of show you readers, show you viewers where I came up with some of these numbers, where these ideas, where these concepts are coming from. And so when you read that bottom line, when you see that valuation, when you see these numbers, it all makes sense. You know, I'm not, there's no trickery here. I'm not pulling these numbers out of thin air. I'm basically digging into actual financial statements from a company. I'm actually going through and distilling that information into easy to understand concepts and numbers, and then these videos break that down even further and make it extremely easy to understand. You know, where is this coming from? Where is this idea at? Where did this number come from? And everything else. So, welcome to another video today. We're going to kind of dig right into what we're going to get into. So, of course, if you're new to this video series, I've been doing this for a little while. If you're new to the written series, the Undervalued Dividend Growth Stock of the Week series, you can find all that at dailytradealert.com. If you're under the Dividend Growth Investing heading, you click on the Undervalued Dividend Growth Stock of the Week tab, and that'll bring you to the archive of the entire series, dating back to 2014. So going on 4 years now, which it's been a wonderful ride, and I hope you readers have followed along. And if you've invested in some of these stocks along the way, you know, you've been collecting growing passive dividend income all along the way, and you're probably looking at quite a bit more wealth and passive income as a result if you've been kind of following along and investing in these stocks, which I certainly do invest in these stocks. So I don't just talk the talk, I walk the walk here, guys. So when I'm writing about these stocks, almost all of them, I'm actively investing in these stocks. So I'm writing about them, I'm buying them, I'm adding it to my personal portfolio, which I link to in every article. And that portfolio, that personal dividend growth stock portfolio of mine, generates the 5-figure passive dividend income, which is growing. It generates that passive dividend income I need to actually cover my bills in life, which has rendered me financially independent in my early 30s. So I don't just talk the talk, I walk the walk, and I've personally benefited to a pretty significant degree from this investment strategy, from all the stuff I talk about, from all the stuff I write about, from these actions. I personally benefited to the point where I'm able to kind of live the life of my dreams in my 30s. So we provide this free content, these free articles, these free videos to inspire you and to motivate you to hopefully achieve the same thing, to live your dreams out. So that's the archive, and I selected for this video today Ventas, which I'm gonna click off the archive because I've already got the article open for Ventas, which is a real estate investment trust, which we're going to get into. And of course, as I've talked about in prior videos, as I write about in every article, each article starts out with what I call a big idea. It's kind of a big concept. It's a way to bring you readers into the fold, into the article, into this investment strategy, into this lifestyle. It basically is the buy-in. It kind of tells you, you know, why should I be interested in this stuff? Why should I be inspired? Why should I be motivated? What will this do for me? And each article kind of lays that path, if you will, kind of lays that concrete out toward the promised land. I do it in a slightly different way. I kind of have us take a different path with every article because I certainly don't want these to be boring for you guys. I don't want to be bored by writing them. I've been writing them for many years, and every week I look forward to presenting a new idea, presenting a new concept, thinking of a slightly different way to bring these age-old concepts to mind. So with this particular article with Ventas, I was inspired myself to actually write this big idea to start the article off with, because I live here in Chiang Mai, Thailand, which is essentially where I'm living my early retirement out. And there are a lot of these meetups where they have these clubs or these meetups or whatever, and they have 1 or 2 a week, pretty much every week here in Chiang Mai. And what they are is they're for cryptocurrency investors, and I use that word investor pretty loosely. But what they're designed to do is they're designed to bring a bunch of people together and kind of talk about cryptocurrency and why this is why cryptocurrency is a phenomenal investment strategy, and why you're going to become an overnight millionaire if you get into cryptocurrency and this and that. And I've been invited to some of these meetups, and I kind of have a pretty good idea of what they're all about. And I also do take part in other meetups here in Chiang Mai, which are designed for entrepreneurs, maybe for bloggers or for writers, things that are more in my wheelhouse. And invariably, I hear about cryptocurrency when people find out that I'm an investor. Of course, one of the first things they ask about is cryptocurrency. So I kind of fleshed out some thoughts in this article, bringing it back around to why Ventas is an appealing long-term idea. So I start off with cryptocurrency, and then as we see throughout this video and throughout the article, you'll see kind of why cryptocurrency maybe isn't too appealing, but conversely, and just as pointedly, why Ventas is maybe a better long-term investment idea. So the first sentence here, which is really the crux of it, you should have a high degree of confidence that a company's products and or services will still be in demand, preferably more in demand decades from now. That's essentially a primary responsibility of any long-term investor, in my opinion. So if you are a long-term investor, that's one of the first things you should be thinking about when you look at a potential business for investment. You should be thinking, what degree of confidence do I have that their products and or services will not only still be in demand decades from now, but preferably more in demand, therefore increasing their revenue, increasing their profit, which will result in increasing dividends, right? So that's one of the first things that you got to be looking at is what degree of confidence you have. And questioning my confidence is something I do every single time I look at a company for a potential long-term investment. And my conviction in this responsibility has never been more tested than it has been lately, because I've been barraged, as I was just alluding to a few moments ago. I've been barraged with stories about cryptocurrency, news stories on the media here in Chiang Mai from people who are, obviously going to become overnight millionaires and stuff like that. So when I look at cryptocurrencies, I ask myself, to what degree of confidence do I have that they'll be in demand decades from now? And you should probably ask yourself that. Ask yourself, really, what degree of confidence do you have that any of the 1,000 or so Bitcoin or cryptocurrencies, that exist right now, what degree of confidence do you have that they'll be not only in demand decades from now, but in greater demand? And for me personally, I have almost no confidence whatsoever. And frankly, I have no idea whether any of these cryptocurrencies will even exist at all a decade from now, or even 5 years from now. I have no clue. And I kind of talked about the blockchain technology here. I mean, that is interesting, definitely, as far as I can understand it. But there's over 1,000 different cryptocurrencies in existence right now. So will any of these go on to actually become a widely accepted currency in real life? I have no clue. I have no clue. Which of them, if any, no idea. So when you start thinking about that, when you start thinking as a long-term investor and you start saying, if you accept the idea, if you accept the concept that one of your greatest responsibilities as a long-term investor is to ask yourself that question I posed, to what degree of confidence do you have that that company's products and or services will still be in demand, preferably in greater demand, over the long haul? If you accept that as a question you should ask yourself before you get into any investment, and then you kind of relay that to cryptocurrency investing, if that's what you want to call it, then I have no idea how you could then make the mental leap or make the leap of logic that cryptocurrency would be a good investment. I don't see how those two concepts can exist simultaneously. I don't see how you can say, well, I want to have a degree of confidence as a long-term investor that the products and or services will be in demand or greater demand, and then also I want to get into cryptocurrency. I don't see how those two things can happen simultaneously. Now, you can be a trader. You can just say, well, cryptocurrency is just kind of a speculation. It's a speculative call, and that's all fine and dandy. But if you're reading these articles and you're reading these articles because you're a long-term investor, then I don't see how cryptocurrency could be appealing or even like a rational idea at all. And I've been hearing about cryptocurrency for a while now, and I have no idea what the prices are at for these cryptocurrencies. I don't track them. I don't care. talking about cryptocurrency is like talking about the dust on Mars. The price of dust on Mars would mean just as much to me as the price of cryptocurrency of any kind. So it makes there's no relevance to my everyday life, right? So I have no idea what they're at, but I remember hearing about Bitcoin a lot when it was 19,000. I know it's way down there now. I have no idea what it's at today. Maybe 5,000, maybe 10,000. I don't know. I know it's a lot lower. That's all I understand about it. But you know, if you are a long-term investor and you're a rational, reasonable long-term investor, and you have a high degree of rationality in your life, then you know, cryptocurrency probably doesn't make a lot of sense. That said, we do have an idea today that when you do pose yourself that question, what degree of confidence do I have that these products and or services will still be in demand over the long haul? Well, the stock that we're going to get into, I think, at least for me, when I ask myself that question, I have a pretty high degree of confidence, and we'll get into that a little bit. So we talk about dividend growth investing in every article. I won't go over this too much, but I basically talk about, you know, why this strategy works, how it's actually worked for me, which I talked a little bit about at the outset of the video here. You know, I've used this strategy to unlock financial independence for me in my early 30s. So I'm not making this up. The portfolio is not a figment of my imagination. The dividends are real money, real cash flow flowing into my brokerage accounts pretty much every single day. I actually own more than 100 different stocks. I have equity in 100 different businesses. And most of those companies pay out a dividend quarterly. So if you add that up, over 100 times 4 on average, you know, you're getting 400 dividend payments a year. There are 365 days a year. So I'm essentially getting paid a dividend every day. And one of the things I like to tell people is a dividend a day keeps the unwanted job away, right? So if you invest in these companies and you're being very rational and very reasonable about it, and you're going into really wonderful world-class businesses, and you're collecting that dividend income and reinvesting and building your portfolio out, guys, it's almost inevitable that you'll become financially independent, and you'll, you know, be able to make your dreams come true and pursue whatever passions you have. If you're into radio control cars, if you're into target practice with a bow and arrow, if you're into playing around with electronic gadgets, if you're into woodworking, if you're into whatever it might be, but if you have time, if you have all the time in your day, if you own your own schedule, if you own your own time, because I don't think there's anything else worth owning more than your own time. If you control your schedule and own your time, guys, I mean, the world is your oyster, you know, to a degree. I mean, you can do whatever you want. You can make your dreams come true. You can live a really wonderful, happy, and fulfilled, purposeful life. And that's really the name of the game. So I get into dividend growth investing, what it's done for me, what it can potentially do for you, why it makes sense, but of course, why we should be looking at valuation, because as with anything else, when you buy a stock, it's important to understand or have a reasonable estimation of what the value of that stock is. It's just like anything else. Just like if you were going to go buy a house, you know, if a house is priced at $200,000 and you have no clue what the value of that house is, then what does $200,000 mean? It means nothing. It's just a number floating in the air. You need to have context. You need to give context to that price, and that's what value does. It gives context to price. So if a realtor comes out with a bunch of comps and says this house is, you know, it's maybe worth $220,000, $230,000, and it's priced at $200,000, then it would be an undervalued house. Conversely, if they put the numbers together and say, you know, this house is maybe only worth about $175,000, then it's an overvalued house. It's the same thing with anything in life. You know, whenever you're engaging in transactions throughout your day-to-day life, you're making a call subconsciously most of the time on price relative to value. When you're buying your groceries, you're saying, oh, is that a good deal or is it not? Well, stocks, it's perhaps never more important than dealing with stocks, because the value you pay, the price you pay relative to value, I should say, when you buy a stock will have pretty significant impacts on how that investment plays out, especially over the short term. And when talking about undervaluation, i.e. when the price is below its the estimated intrinsic value of the stock, this can have substantial positive benefits. It confers significant positive benefits to the long-term investor, which I break down in every article and I break down in every video. An undervalued dividend growth stock should offer a higher yield, greater long-term total return potential, and less risk. That's relative to what the same stock might otherwise offer if the stock were fairly valued or overvalued. And I kind of break down why that is true. And it's not just like, again, this isn't just a thing where, you know, maybe it's true and maybe not. If you are if you are looking at a high quality dividend growth stock and it is undervalued, and you're very confident about that. Now, again, when you do value a stock, it's an estimate. When I put these numbers together in these articles, it's an estimate, but it's a pretty reasonable estimate. So the odds of it being significantly off are pretty low. So when you do have a reasonable estimate there and you're paying a price that's well below that reasonable estimate, then these benefits are pretty much guaranteed to come your way. And that's the higher yield, the greater long-term total return potential, and the less risk. And I break down how that works out. And then, of course, I link to fellow contributor Dave Van Knapp's lesson on valuation, which really streamlines the process of valuation. He provides kind of a template, if you will, and that template can be applied to almost any dividend growth stock out there. And I link to that right there. So if you want to do this on your own and you want to value these stocks on your own and you follow that template, it should give you a pretty good idea after you go through the process about, with a reasonable degree of accuracy, what just about any dividend growth stock is worth. And that provides context to the price, which puts you in control when it's time to actually invest. So with that all in mind, we're going to highlight a high quality dividend growth stock that appears to be undervalued right now, which is Ventas Inc. Of course, I spoiled the surprise at the outset. We know what we're getting into. This is a real estate investment trust, guys, that invests in healthcare facilities that include seniors housing, skilled nursing facilities, hospitals, and medical office buildings. Their investment portfolio encompasses interests in more than 1,200 properties spread out across the U.S., Canada, and the United Kingdom. And again, as I talked about at the outset of the video, I kind of relay this back to cryptocurrency, bringing things back to my earlier discussion on cryptocurrency. A new cryptocurrency, guys, check this out. A new cryptocurrency can practically be created out of thin air at any time. So when you think about the value of any cryptocurrency, and you think about if it's a store of value or whatever you want to call a cryptocurrency, you just think that Joe Schmo in his basement can just, spit one out of his computer almost at any given time. So how much value do any of them have when anybody could just invent one? And there's over 1,000 of them, and nobody has any idea what they're worth. I don't know how you make a rational call on something like that. However, you cannot create out of thin air a real estate portfolio like that of which Ventas controls. You can't just out of your imagination, there's a building, there's a real property with real people living in it, producing real cash flow. It doesn't work like that. So when I think about what will hold long-term value, what will probably be more in demand a decade or 2 decades from now, if I'm going to bet on real estate or I'm going to bet on cryptocurrency, my take is real estate. So these are real properties with real value, and I have a high degree of confidence that they'll be in demand for decades and decades, probably more in demand, as I'll just break down right here. There's a large global trend that serves as a massive tailwind for this company, ensuring my high degree of confidence. That trend is the fact that the world is growing older, larger, and wealthier. It's a trifecta of a trend. To wit, the 75-plus population in the U.S. is growing 7 times faster than the general population per the U.S. Census Bureau. So as that continues to play out, demand for the very properties that Ventas invests in will almost certainly increase, because as we get back to, again, they invest in healthcare facilities that include seniors housing, skilled nursing facilities, hospitals, and medical office buildings. So as people get older and wealthier, and as more of these people are around, as there are more older and wealthier people, then, are they not going to increase demand for these types of properties? Absolutely. Absolutely. So said another way, if you have the ability to live a longer and or higher quality life, you're going to do whatever you can to see that through. Then couple that with more people who are walking around simultaneously living longer than ever before. It's plain as day. So it's easy to see how this trifecta of a trend bodes well for Ventas. Getting into the dividend metrics, of course, we're dividend growth investors. I'm a dividend growth investor. If you're watching this video and reading this article, very likely you're a dividend growth investor. So let's kind of break down the dividend metrics, guys. They've been increasing their dividend for 8 consecutive years, which we can pull up David Fish's Dividend Champions, Contenders, and Challengers list, as I've already done. And you can pull it up on the Dividend Growth Investing heading there, and I linked to it in the article. So you got Ventas Inc. They've got 8 consecutive years of dividend increases. And I really think that track record's just getting started. I think the odds of Ventas one day having a multi-decade run of dividend growth is pretty high. And I'll kind of break down why I think why that's happening. And so we've got the dividend growth, and when we're looking at dividend growth, we're of course expecting dividend growth to be at least in line with inflation, if not higher, so that our purchasing power at least stays the same, if not increases. But what's really wonderful about Ventas is you're starting off with an extraordinary yield here of almost 6%, and the stock has actually come down a bit since I've written this article, because I wrote this article, the last week for the stock market's been up and down, and I think we had a couple. I don't really follow the stock market day to day because I live off of dividend income, and so I don't need to look at things every day. It's just doesn't really have an impact on my day-to-day living. But I know Ventas has dropped a little bit because I recently added to the stock myself, and the stock market. I think the Dow Jones had 2 1,000-point drops in the same week. I don't think that's never occurred before. So almost any stock I would have presented last week would be lower today because of where the market has been. So looking at the yield today, I had it at 5.78% when I wrote the article, and let's look at where it's at now. So we've got a dividend of 79 cents, right? Let me just check that. Let me scroll over, make sure it's not a half a cent there. Yeah, 79 cents, right? So we've got a yield actually of over 6% now, 6.13%, which is higher than the 5.78. Now, when I mentioned earlier that undervaluation should lead to a higher yield, which then corresponds to a greater long-term total return potential, because income is one component of total return, the largest component actually. The 5-year average yield for Ventas is 4.8%. The yield now is over 6%. So you're looking at a starting yield. So think about that for a moment. Investors over the last 5 years, on average, have been willing to accept a yield of 4.8% on Ventas stocks. When they've been buying Ventas stock, they've been saying, yeah, 4.8%, that's okay. Now you're looking at a 6% yield. So you're automatically looking at a major advantage relative to where investors have been sitting on average over the last 5 years. And maybe if you bought Ventas a while ago, maybe where you're sitting. So when you look at value and yield, when you look at price and yield are inversely correlated. All else equal, a lower price will result in a higher yield, assuming the dividend is unchanged. So you're basically kind of locking in a much higher yield relative to where it's been on average over the last 5 years, which of course gives that potential long-term total return a major boost right off the bat, and then also just results in more income for you to collect and compound, and or reinvest. So it's just a huge advantage here. And I mean, 6% plus yield in this environment where interest rates are rising, but a 6% yield is still extremely appealing. There's just not a lot to dislike about a 6% plus yield, especially on a dividend that's pretty safe, which Ventas does look very safe across the board. So that's more than 100 basis points higher than the stock's 5-year average. That's really strong. And then on top of that, you're not just looking at that 6% dividend just coming in, month after month, year after year or whatever. You're not just locking in that annual 6% dividend. The dividend is growing, as we saw, 8 years of consecutive dividend growth. And if we want to look at what kind of growth you're looking at with Ventas, you're looking at a 5-year dividend growth rate of 7.6%, which I noted right here. So, I mean, if you're looking at a yield of 6% and dividend growth in the mid-single digits, total return, you can approximate your total return by adding up your yield and your dividend growth. So assuming a static valuation, the sum of your yield and your dividend growth should approximate total return over the long run. So if the valuation changes, and that will obviously change your total return because that will result in lower or greater capital gain. But when you're setting up with this, when you're kind of setting the game with a 6% yield, and then you're getting pretty strong dividend growth on top of that, I mean, the odds of you doing not well over the long term, I mean, you're just setting yourself up for really good numbers. Now that said, the dividend growth for Ventas has slowed down quite a bit, as I noted in the article. The most recent dividend increase was just 2%. You can kind of see that deceleration occurring here. 3-year dividend growth rate is 6.5, 1 year 5.1, and then it's really kind of dropped a little bit. But that said, with a yield of 6%, you don't need massive dividend growth to look really good, especially if you're an older investor who is more in need of current income. Then the dividend growth is not really of massive importance. But again, still, if Ventas can deliver low single-digit dividend growth, 2, 3, 4%, you're setting yourself up for very attractive total return, probably on par with the market, while collecting most of that in the form of that giant dividend. So there's really a lot to like there. And the payout ratio, we've got a payout ratio of 75.2% against trailing 12 months FFO a share. So that's very reasonable for a REIT. Of course, REITs, the way they're set up, they have to pay out at least 90% of their net income in the form of the dividend. Some real estate investment trusts don't have net income though, because of the way they report GAAP net income. and earnings per share. So sometimes that doesn't mean a whole lot, but it usually kind of sets you up for a big dividend. I mean, most REITs pay a big dividend because of the way the business structure is. But really, in order to get an accurate look at the payout ratio, you're not looking at earnings per share, you're looking at funds from operations per share. And for Ventas, that's 75.2%, which is very reasonable. A lot of the REITs I invest in have payout ratios. When you're looking at FFO share, TTM, you're looking at somewhere between 70 and 80-ish%, somewhere in that range. So Ventas is kind of right in that wheelhouse for a very comfortable payout ratio. I wouldn't like to see it get a lot higher than that, up in the 80s, mid 80s. But frankly, there's no reason why I also think there's any reason for it to be lower. And could it not expand a tad? Would I still feel comfortable with it being at 78, 79, 80%? I would still feel pretty comfortable with that. So the flexibility there with Ventas in terms of their dividend growth, not just in terms of FFO share growth, which will drive dividend growth, but also the payout ratio being pretty reasonable. There's definitely some flexibility. There's multiple levers for them to kind of pull and make sure that investors, shareholders continue to collect those dividend raises. So, and as I note here, you don't often see a yield of 6% along with 7% annual dividend growth, and that's what you're kind of getting here with Ventas. Keeping in mind that the dividend growth has decelerated, but still, again, if you're getting a yield of 6%, are you going to then expect dividend growth of 7, 8, 9% a year? You shouldn't be. You shouldn't be. That's not the way it works. Generally speaking, I mean, it's very rare that you'll see something like that for any long period of time. Generally, with the yield of, the dynamic is such that when you get a higher yield, the growth is going to be lower, and conversely, higher growth stocks tend to have much lower yields, or maybe even no yield at all. So that's the dynamic you're playing with. So it just depends on what kind of investor you are, maybe how old you are, what kind of goals you have in terms of income, what kind of portfolio you have. For me, I'm kind of a mix between a young and old investor. In terms of age, I'm 35 years old, so I'm a young investor, technically speaking, but I'm also kind of living like an older investor because my dividend income pays my bills. So I'm kind of in this very unique, rare type of position in life. And for me, Ventas does have a position in my portfolio, does have a spot in my portfolio. I do have a stake in the company, in the real estate investment trust, because that high yield that Ventas provides offsets some of the lower yielding, higher growth stocks I have, like a Visa, like a Nike, like a Starbucks. So I think when you blend out those type, those holdings like that, I think there's room for a faster growing company with maybe a lower yield but greater dividend growth, and I think you can kind of offset that and blend that with a real estate investment trust like Ventas. I think there's room for both for almost every investor out there, really. But again, that all said, I'm kind of in a unique position there based on my age, but also based on some of my investment goals because I want that income. So, but nonetheless, it's still a combination. It's an uncommon and wonderful combination of income and growth that's really, really appealing here, because you're really not sacrificing too much of either. You're getting plenty of income, one of the higher yields out there in the high quality dividend growth stock space, and then you're getting dividend growth that's at least keeping up with inflation. I mean, U.S. inflation is in the low single digits right now, so even if Ventas grows its dividend at 2-3%, drops way off, and that's permanent, unless inflation were to spike up significantly, your purchasing power is at least staying the same, and you're setting yourself up for pretty good total return, assuming a static valuation. So there's a lot to like there. So let's get into the growth of Ventas, of course, because that'll help us value the business. It'll also help us build an expectation for future dividend growth, getting to that number that we were just talking about. So we're going to get into top line and bottom line growth here. We're going to look at the past 10 years, which kind of sets us up for what we might think they're going to do going forward, and then we're going to compare what they've done over the last 10 years, using that as a proxy for the long haul, to a professional estimate for forward-looking, for a professional forecast for forward-looking FFO share growth. So first, looking at revenue, we're going to pull up some financial statements here. I've got the financial highlights for 2007, and I've also got the 2016 10K and the 2016 Chairman's Letter. So we've got some numbers here that we can work with. We've got total revenue for fiscal year 2007 at $772 million, which I've noted right here, right? Fiscal year 2007, okay. And then we've got the financial reports for 2016. I've got the 10K. We've got total revenue of $3.44 billion. I rounded that up. 3.44 billion fiscal year 2016. So you see where I got those numbers from. And then we just use a compound annual growth rate calculator to figure out the compound annual growth rate for those numbers. So we've got the first number, again, 772 million. So we're going to plug that in. I use Investopedia's compound annual growth rate calculator, but you're free to use whichever one you like. They all work the same. And then we've got 3444, right, for the ending number. And then we've got 9 compounding periods because the first year isn't a compounding period, it's a starting point. And we've got 18.08% for the compounding growth rate for revenue. Now that might seem absolutely unbelievable on the face of it, but that's because real estate investment trusts like Ventas, they routinely issue debt and equity to fund growth. So they'll issue debt, but they'll also issue equity. And what I mean by that is they'll dilute shareholders by issuing shares. They'll at the market ATM. So keeping that in mind, so when you're diluting shareholders to fund growth, on a per share basis, the growth isn't quite as outstanding because you have to account for all that equity. So the revenue growth, looking at real estate investment trusts, it's something to look at, but it's really not a terribly meaningful number. The meaningful number, the real number that we want to look at is what growth is, not only on a per share basis, factoring in any dilution that's occurred to fund growth, but also we want to look at true profit growth for a real estate investment trust. And to get that number, you can't look at GAAP EPS because the GAAP EPS includes things like depreciation. And of course, when Ventas invests, when a real estate investment trust buys a property and they buy real estate, on paper, when they actually report their numbers, that property is technically depreciating. But in real life, we know that real estate should appreciate over time, not depreciate. So the number that the industry accepted numbers, funds from operations, that, and I kind of talk about what this does right here. The industry accepted metrics instead is funds from operations. This adds back in depreciation and amortization to earnings while also subtracting any gains on sales. So it's more of a real true look at profit for real estate investment trusts. It's an industry accepted number, been using it for a long time, and that's really the accurate number to look at. So we're going to look at funds from operations on a per share basis and look at true growth of Ventas. So the first number we're going to look at is FFO share back in fiscal year 2007. We've got FFO diluted on a per share basis of 307. And I've got that number right here, guys. And then the newest number for the most recent fiscal year, FY 2016, we've got that right here. Normalized FFO attributable to common shareholders per diluted share, 413. FFO attributable to common stockholders per diluted share, 2016, 413. This is on the chairman's letter for 2016, essentially the annual report minus the 10K, which I also have pulled up. And I have that number right here. So we've got 307, 413, and we've got 9 compounding periods. That's obviously unchanged. So we've got a compound annual growth rate in FFO per share of 3.35%, which I've reflected in the article. So that's really the true growth rate of Ventas. That's really what Ventas is growing at in terms of true profit on a per share basis. That's what you're looking at with Ventas. You're looking at, call it 3.5% annual growth, which again, could that not fund like dividend growth, assuming the payout ratio doesn't change too much? Yeah, sure. And with factoring in that 6% yield, is that a lot to like? Absolutely. So that's what they've been doing over the last decade, which gives us a pretty reasonable expectation moving forward, assuming that the last 10 years will be somewhat akin to the next 10, which I don't see any reason why it would be terribly different. But of course, I blend that with a forward-looking forecast, professional forecast on their FFO per share growth moving forward. And we've got this at CFRA. We've got the 3-year FFO per share projected compound annual growth rate right here at 2%, which I note right here, looking out over the next 3 years, CFRA is calling for Ventas to compound its FFO share at an annual rate of, they changed this. They have it at 2%. They had it at 3 on the, right here. February 9th, 2018. They changed their numbers on Ventas. So this was after I wrote this article, because I'm shooting this video on the 11th, and I wrote this article. I actually compiled the information on this article in early February and published the article a few days later. So they've changed that. So it's not really a huge deal. They're basically just saying that Ventas is maybe going to grow slower than they had anticipated prior to or on the previous analysis they put together. They lowered their 12-month target price, and they would have lowered their valuation as well, which we'll look at as we go throughout the article. So they've got it at 3 to 2. Is it Is that going to make a huge difference to what we're looking at with Ventas? I really don't think so. But is Ventas going to drop from 3 to 2? That's another thing altogether. But regardless of whether you have that at 3 or 2 over the next few years, I would be more obliged to. I would be more encouraged to look at what Ventas has done over the last decade, because frankly, the last decade has not been easy for Ventas or any company. And I've noted this before in prior videos. When looking at the last decade for all these companies, it's a pretty good stress test for most companies, because it includes the financial crisis and the Great Recession and everything else. So would the next 10 years not be easier for a lot of these businesses? You would think so. The last 10 years has been really, really tough for a lot of companies. So is this not a pretty good baseline expectation for Ventas, the 3.35% for FFO share growth and dividend growth? I think it's a reasonable expectation. Could you slow that to 2? You could. Could you maybe put it somewhere in the middle, split the difference, call it 2.5, 2.7? You could do that too. So nonetheless, these numbers are not terribly different in a percentage basis, because they're so small. It might be, but in actuality, in reality, it's not that massive of a difference. But nonetheless, they're calling for 2 now. It was 3. The most recent dividend increase, for perspective, was under 2%, which is right in line with what CFRE is calling for future FFO share growth. And frankly, that's where it should be for Ventas. They shouldn't be growing their dividend at 7% a year. That 5-year dividend growth rate is really, again, as I talked about earlier, an unreasonable expectation moving forward for Ventas' dividend growth. I would not. If you're buying Ventas with the expectation that 5-year dividend growth is just going to continue on indefinitely, you're making a huge mistake, because I don't think it's going to happen. There's really nothing to indicate that would continue. If anything, the numbers are indicating that you would want to expect dividend growth in the low single digits, and we'll kind of build that expectation as we go. And we're really building it right here. You're looking at FFO share growth that should fund like dividend growth. You're looking at a payout ratio that's pretty moderate, but shouldn't really move too much either way, lower or higher. So FFO share growth and dividend growth, they should roughly match each other. So you're looking at dividend growth of 2 to 3%. They've grown at 3, 3.5. We're maybe looking at 2 going forward. Maybe not. But again, 2.5, 3. That's probably where you're going to be at. But again, as I note again, Ventas does not need to go out and grow at 7% annually in order to make this investment very worthwhile over the long run. They just don't need to do it, because you're starting off with that massive dividend. If you're looking at aggregate total passive income over the long run, and you're starting off with a 6% yield, you just don't need massive dividend growth to make the numbers work out very favorable, very advantageous to you. So, and I note right here, I'm a shareholder, and I can tell you that I would not be at all unhappy if Ventas manages something between 3 and 4% growth over the next 5 to 10 years on an FFO share basis. I would not be unhappy with that at all. If they came out at 2, I'd be maybe a little disappointed. I'd prefer something closer to 3. 4 would be awesome. If it's 2, it's not the end of the world. But if they come in at 3 and they continue like they have been, that would not be. I wouldn't be disappointed or anything with that. Especially if they can fund like dividend growth. If I get a 6% yield and I'm looking at 3% dividend growth, that's fantastic for me. So the next thing we're going to get into is the balance sheet. I've got the 2016 10K pulled up for that. And I noted in the article total liabilities, total equity. We've got total liabilities right here at $12.4 billion. We've got total assets at over $23 billion. I've got that noted right here, $23.2 billion in assets against $12.4 billion in liabilities. You got a 2-to-1 ratio there, which is very, very solid if you look across the REIT space. And I've got the balance sheet ratings right here, BBB plus from Standard & Poor's, and we've got a Baa1 from Moody's. Again, these are very solid numbers, nothing to really be concerned about. So there's a lot to like about Ventas, guys. We've got those tailwinds I mentioned earlier propelling the company's long-term potential. They're numerous and significant, and they're unlikely to abate anytime soon because of the growth rate in the 75-plus population. You can't have a portion of the population growing at 7 times faster than the average population, and then not somehow have more customers when they're when those are your customers. It'd be like all of a sudden the population of children growing at 7 times faster than they usually are, and then saying, well, Disney's not going to benefit from that or something, or infant milk or something like that. I mean, when you have when your wheelhouse, when your core customer base is growing that much faster than every other population group, then you're going to have more customers. It's inevitable. So, and people of a certain age that require healthcare, including appropriate housing, which is where Ventas is at, they're going to do whatever they can to get it. And with more people growing older and wealthier, the client pool for Ventas will almost surely expand. I mean, it's just logic, right? So there are risks, though. I note these here, including regulation, possible healthcare reform, which is an ongoing issue in the United States, changing supply and demand dynamics. Those have to be considered as well. All in all, though, considering those risks against the business model, which we're talking real estate, and we're talking real estate for an elderly population that is going to do whatever they can to access that, and that population is growing much faster than the average population. It appears to be a low-risk avenue into both real estate and healthcare simultaneously. And these are both industries. If you look at the healthcare industry and you look at real estate, these are industries that have created massive amounts of wealth for people over the long run. And you're getting both with Ventas. You're getting real estate and you're also getting healthcare, and you're getting them both mixed into one. So, you know, that's a pretty nice combination right there. So while a new cryptocurrency can be created tomorrow out of thin air, you just can't physically go out and create this kind of real estate portfolio overnight. It just doesn't happen. Not possible. So, and I note again here, while it's pretty much impossible to actually value any cryptocurrency out there, to actually say it's intrinsically worth X dollars, you can estimate with a reasonable degree of accuracy the intrinsic value of a company, especially real estate investment trusts. To that point, the valuation does look quite attractive here. So when I wrote the article, the stock was trading hands for 13.46 times trailing 12 months FFO a share. You know, you really can't compare that to a price to earnings ratio on a typical stock. It's not apples to apples completely, but they're roughly analogous, and that's pretty attractive, pretty appealing considering the broader market sports a PE ratio of almost twice that number. Of course, before the little drop over this last week, which of course drops this number too, so they're both dropping, and they're, you know, so in comparison to one another, it's similar. And when we want to look at that valuation, let's pull these numbers up here. This is Ventas's current valuation using basic valuation metrics like PB, price sales, price cash flow, the yield, of course, we noted earlier. And now again, this PE ratio of 26.2 isn't really a number you should be looking at. Nonetheless, we can compare it to the 5-year average, because that's comparing apples to apples. You're comparing its current PE ratio to its 5-year PE ratio. Even though this would be like, whoa, I can't pay 26 times earnings for a stock. You know, it's not reasonable. The actual looking at what you're paying for profit per share, it's actually closer to 13 times. But nonetheless, 26 compared to 42, we've got price to book 1.7 to 2.2, 5-year average. Price of sales at 5.2 compared to the PS ratio, the 5-year average is 6.7. We got price to cash flow, 3-year average of 15.8 times. We're currently at 12.8. So no matter how you slice it, guys, Ventas compared to its 5-year average. I mean, you could argue that maybe it was expensive on average over the last 5 years. You know, you could make that argument, but it's way down compared to where it has been on average over the last 5 years. So we kind of start to make some. I'm going to click off these because this causes my computer to run kind of fast or slow. Excuse me. We can start to make some assumptions on the valuation when we look at these numbers. So when you start to kind of look at this and say, well, these numbers are way lower than they have been on average over the last 5 years. So unless the business model has completely collapsed or something, I mean, this is starting to look pretty appealing, right? The next thing I do, is I do a dividend discount model analysis. I do this with every dividend growth stock I invest in and or write about. And with this one, I'm using an 8% discount rate due to the high yield, because I'm willing to accept a lower total annualized rate of total return on a stock that's pumping out that massive of a dividend. I'm okay with collecting most of that in cash and maybe giving up a little bit of future growth. And then I use a long-term dividend growth rate of 3%, because that's a little below what Ventas has been growing at over the last 10 years. Like I said, the last 10 years has been really challenging for a lot of companies, including Ventas. So my logic would be, my line of thought with that would be that if they've been growing at almost 3.5 over a very challenging 10-year period, would the next 10 years not be set up to be better? I would think so. CFRA is calling for it to be worse. You know, and I think that they're calling for that to be worse because there's a supply and demand issues with the industry right now. They've been building up quite a bit, anticipating all these new customers due to the demographic trends we were laying out earlier. So, you know, that could cause some bumps in the road over the short term, but this is a very, very long term. When you do a dividend discount model analysis, you're looking at the very, very long term of a company. And does Ventas's very long term not look better than the last 10 years? I would think so. So I'm at 3%, which is still actually under what they've grown at on an FFO per share basis over the last 10 years. So I'm being conservative there. I'm saying that they've grown almost 3.5 over a very challenging 10-year period. I think they're set up even better over the long run, but I'm still going to keep that at 3. So I think that's a pretty reasonable look at the company's potential in terms of long-term dividend growth. So the first thing we need to know is what their dividend is already at. So we're going to scroll back down on Morningstar here. So you've got the current dividend at 79 cents. So we've got an annual dividend of 316, and I'm using MoneyChimp's discounted cash flow calculator. I'm just substituting dividends for cash flow, so that's what the dividend discount model is basically. You're just using a tailored version of the DCF model for dividend stocks, so it's the dividend discount model. And then I've got the growth rate at 3, of course, as I noted, and I've got the discount rate at 8. So I've got a fair value at 65.10 on the stock, which I note right here. And I include some information here on why the dividend discount model analysis, why I use it, why I think it's a pretty accurate way to value dividend growth stocks. And of course, you can compare that against Dave Van Knapp's earlier linked lesson on valuation, and he includes a template. So when you're looking at valuing stock, you know, the more information you have, the better, and you can look at it from multiple angles. And the dividend discount model analysis, of course, is sensitive to input, but I think this is a very rational, very reasonable, even conservative look at the valuation of Ventas, of the real estate investment trust, of its shares. 65.10. I think that's a very reasonable estimate of its intrinsic value. So if you're able to pay a much lower price, and of course we see the stock at 51.59, I mean, you know, I mean, Ventas would have to slow its growth to almost nothing to say, well, it's only worth 52 bucks a share. I think that's a very, very good deal on the stock right now. So I know, you know, where I come up with that, where the dividend discount model analysis fits in here, and right here, based on my valuation and analysis, the stock is at least moderately undervalued here, perhaps substantially so, because I think I'm being pretty conservative. But my perspective is but one of many, of course. I'm just one guy, one investor, one person. So let's compare my valuation with what professional analysts have come up with what they've concluded in terms of valuation. The first one, we lead off with Morningstar, and we're going to pull up Morningstar's valuation right now. They've got it as a 4-star stock. They rate their stocks 1 to 5, 3 being fair value, 5 being extremely undervalued, 1 being extremely overvalued. They've got their fair value estimate at 65 bucks. So I came up with within pennies of where Morningstar is, right? I came up with 65.10. Morningstar's at 65. That's within just a few pennies. That's pretty good stuff. And then we use CFRA as a second professional analysis firm, and as we saw a little bit ago, they've lowered their numbers since the article came out, but Ventas' stock has dropped a little bit too. So you know, looking at the revised numbers, it still looks very undervalued. So let's look at where they're at now with it. They've got it at 53.25. They've got it as a 4-star buy still, probably keeping in mind that the stock has dropped. So even though their valuation has dropped, the stock price has dropped too. So they still have it as a 4-star buy, which I think they did before. They did, and they have the revised fair value, at 53.25. So let's go through the numbers, guys. Let's just revise this because the numbers have changed quite a bit. Usually with these videos, unless the numbers change a lot, I just keep with what's in the article. But things have kind of changed quite a bit over the last couple weeks. So let's look at that. So let me pull that up again so I get that right, 53.25. Morningstar is unchanged, I'm unchanged. And that's the only thing with CFRA. They change their numbers like almost weekly. So I take some of their numbers with a grain of salt. And frankly, the valuation for a stock, unless something happens with this business, it shouldn't really change that much from week to week to week to week. I mean, a company doesn't just become worth billions of dollars more or less from week to week. And when you're changing, you know, a multi-billion-dollar company, if you're changing its stock valuation by a few dollars per share, then you're changing the value of that business by millions and millions or even billions of dollars. So the dividend discount analysis I really like, because unless the dividend changes, the value of the business doesn't change. It stays where it is, because you're still collecting that ongoing cash flow and you're discounting that back to today. It doesn't change from day to day, right? So nonetheless, let's see where we're at here. We've got the new valuation at 61.12. It's changed a little bit, not that much, but the stock price has probably dropped even more than the value, because these two out of the three values haven't changed. Only one did. So the value hasn't changed, but the stock price has quite a bit. It's at 51.59. So it now looks about 18% undervalued compared to 12 when I wrote the article. So the stock has dropped since I wrote the article. It looks even more undervalued. I actually bought more Ventas stock just the other day. What was it, Wednesday or Thursday or something like that? And today's Sunday, February 11th. I'm shooting this video. So just a few days ago, I bought more Ventas stock, right about where it's at, right about 51, 52 a share. So I think it's very, very appealing here, based on everything I'm looking at. I've got my bottom line right here. Ventas Inc. has one of the largest real estate portfolios in its industry. This niche is a wonderful area to be in, as demographic trends all but guarantee greater demand for its properties going forward, especially over the long run. A yield at actually a little above 6% now. Inflation beating dividend growth, because if it does grow its dividend 3%, that would beat inflation as it sits right now in the US. And the potential at shares are now 18% undervalued. All add up to one of the more compelling opportunities in the REIT space right now for dividend growth investors, which of course is why I personally added to my own position. And we've got the dividend safety score right here. How safe is VTR's dividend? We ran it through Simply Safe Dividends. As we go to press, it's dividend safety score 70. That shouldn't be changed from a couple weeks ago. So that puts us right here, which is a safe, unlikely to be cut dividend. So again, to get a 6% yield on a safe dividend that's growing at or above inflation, not a lot to dislike here. And again, cryptocurrency, have no idea if it's going to be around a decade from now, have no idea what any of the cryptocurrencies are worth. They can be created out of thin air. With real estate, you can value it to a reasonable degree. It cannot be created out of thin air, and the demand for real estate over the very long run, of course, with more people being born all the time, I mean, that the demand for that's only going to, it's almost guaranteed to grow, especially for the space, the niche that Ventas is in, due to those demographic trends that we talked about. So that's the video for today, guys. I hope you enjoyed. Thanks for following along. I hope this provided a lot of value, a lot of context to the article. Hopefully it complemented everything we talked about and broke out some numbers for you guys. Hope you enjoyed. It's a pleasure for me, as always, to shoot these videos. It's a pleasure for me to write these articles. I live and breathe this stuff, literally. So it's just a great honor of mine to present these ideas for you guys. This is free content that we hope inspires and motivates you. And if you're investing alongside these ideas and following these concepts through, it should help you make your dreams come true. So appreciate it very much. Hope you guys have a great day. Thanks so much for following along. Until next time. Bye, guys.